right, hello everybody and welcome to another Pepperstone live event. It's great to have you here, and boy oh boy have we seen some movement over the last 24 hours. We expected it to be Fed driven, but it looks like it's news potentially of tariff deals. Obviously that means that we can talk about some technical momentum indicators, and it's actually perfect for the topic of today, which is two really important and really simple techniques that we can use to potentially get involved in changing trends. How can we do it? What types of timeframes do we actually have to look at? Do we even need certain timeframes, or is it more about price action and structure? Some of those answers we'll have today, and it's great to have you here. So make sure to also ask questions if you're here live, and we'll answer them throughout the session. My name's Thomas Atkinson, and let's get into it. First off, we'll start with the US 500. And the main reason we want to be talking about this, everyone, is, of course, the tariff deal or news. So we saw over the last 24 hours a potential break towards the downside that then was quickly bought up as we got news of most likely a UK/US deal of some kind. And that actually, of course, led on to some pretty strong momentum. Now, I thought I'd do two things here. One, we would talk about the difference between the US 500 and the NASDAQ, as a lot of you guys probably prefer to trade sometimes the NASDAQ due to the nature of the more points and more opportunity there. But at the same time, obviously the importance of why the S&P 500 is the best major read. And it's sometimes like something we use like in currency when we talk about the US dollars, and why we always go with the US dollars more than we do necessarily with, like, let's say looking at the pound US dollar, we'll look at the dollar index first and get a bit of a gauge of dollar strength or weakness. And that's because it often does give us the better reads. So let's have a quick look at the difference here. So we'll go 2 hours on both charts. And why I want to do that is what you may notice here on the left-hand side. Can anyone see what happened on the left-hand side versus the right-hand side? Anybody see a potential trap that's occurred there? Something that's quite common when it comes to trading and investing and scalping and all of those other types of things. We've also got a couple of questions coming in. I'll answer the first one here from Craig while we wait for your answers there, guys. It says, hi, Tom and Tyrone. What is the standard risk for a beginner trader? I got smashed on gold. Sorry to hear that, man. Today, as I didn't put a stop loss in and I watched it just go down and down and down. So it's really, the standard risk is really about account size. And generally people go between 0.5% to around 2% is the standard kind of thing that you'll hear a lot of people talk about, with 1% being the one that everyone mentions. The key is to have an adaptive stop loss. So that means that whenever you're putting a stop loss in, let's say you had a stop loss right now underneath this, then if you are buying, let's say here, and your stop loss is going to be here, and then you're entering in, you don't always enter with the same contract size. You instead use a calculator to work out the risk amount. So let's say your risk amount was $100, then the contract size that you're using has to be equal to $100 to the stop loss. Okay, so that might mean sometimes you're using a single contract. Sometimes you might be using a fractional mini contract. The great thing with Pepperstone and the platforms is that you are able to do that, especially with CFDs. Now, once we've answered that one, the correct answer that came in from a few people was that we saw a lower low on the NASDAQ, but not really on the S&P. And the S&P actually found the previous low and bought off that zone quickly. Now, why that's important is because what this means is that people may have tried to short as the market breaks underneath this very important support, and then it's quickly rejected back up. And what that tells us, actually one of the early warning signs or early signs of a momentum shift. And this can then be used to potentially trade a very basic system. And I'll show you the system that we can use on this and the indicator that we can use using the S&P 500. So we'll go to a smaller time frame. Let's select a 15-minute time frame, which is the popular one for scalping and, of course, trading. And Silvio got it correct. Then we also got Stuart getting it correct, and we got a few others as well with that sweep or stop loss hunt. All right, so let's first up get the anchored VWAP. To get an anchored VWAP inside the platform, you usually go over here to the projection tools, and you'll notice that it's under volume based, which means that it's, of course, adaptive. So one of the things I love about indicators is when they're adaptive. And that means that effectively whatever time frame you're going onto, or when you're looking at market structure, will always be looking for something that is constantly market adaptive, so we don't have to say, oh, yes, it's fixed on this particular rule, and therefore it may not work in this situation. It sometimes works in this situation. We want it to work in all situations, ideally. Hey, Ty, we've got you here. Welcome. We're just having a discussion here about this S&P reversal on the trade news, of course, with the UK. This is a great example of momentum shift, isn't it?
Yeah, absolutely. And welcome. Yeah, well, hello everyone. Yeah, look, we love higher highs and higher lows, and it's certainly done that on a 15-minute chart. I mean, we can see, obviously, everyone can see the momentum.
I might be a little bit quiet there, guys. So we'll just get that one sorted. I think we just need to up that loudness. But I know he's going to say he likes it. All right, let's just go in here then. Yeah, can everyone else hear him perfectly, or is it a little bit quiet there?
Can you hear me?
Not sure.
I don't know.
Okay, well, we'll see what everyone says in the chat here in this moment. Maybe Stuart can say, "You Sylvia, okay? All right, no worries. Maybe it's okay."
I'm loud. Awesome.
Okay,
great.
Perfect. Turn my side up then. There we go. All right, so Ty, we're just going through the anchored VWAP. So basically, we saw a momentum shift. As everyone saw, we had a stop loss hunt that was pretty obvious on the Nasdaq, not on the S&P. But then we started to see that movement up, and because the S&P and the Nasdaq as well, they're both very good technicals. What we then look for is okay, well, can we get involved in this trend in a more safe way? Now, one of our favorites is the anchored VWAP, and what we like to do is we like to put it behind important series of events. So let's just quickly mark these out here. We've got a high, we've got a low, we've got a higher high, we have a higher low, we have a higher high, we have a higher low, we have a higher high, we have a higher low, and then of course we've gone to a higher high. So what could we potentially do with the anchored VWAP that could help us out? We could then say every time we make a higher high and a higher low, we can then put the anchored VWAP behind that last low, that last red candle here. And what that will do is it will then anchor it off that one. And what you'll find is the first touch, often in momentum, can be very powerful for a buy technique. So let's say we've done that so far. You can see here the first one, both levels have been held. Let's go behind this one over here now, the one that leads on to the next movement. You'll see it comes back and it touches that, and then we see a really nice bounce. This is what I like to do if you have a strong or what you perceive to possibly be a very strong momentum move. And then, of course, we can go behind this one up here, and you'll notice, again, it comes back to that anchored VWAP. So this is an adaptive technique that you can use often on your major indices. Now, I would suggest that you use it with highly liquid pairs. The key with anchored VWAP is often to be using it with things that are traded very heavily. S&P 500, Nasdaq, gold, euro, US dollar. These are just some of the numbers that we can go behind and start to look at. And now that we've made another higher high, we could be using the anchored VWAP again, that in the future, if it comes back down to this level, that may be a point where a scalper or a day trader or somebody might be willing to come in to see a buy. So very powerful stuff, isn't it, Ty? It's always behind that last low or last high, especially if you're in a strong momentum. It's a great first touch technique. And the first is important, always first touch.
Absolutely, it is, yeah. And I think that we're seeing, look, the markets are still obviously very volatile at the moment. So, I mean, we know that. So I think taking the dynamic approach and looking at price action for what it is in the faster time frames is definitely the way to approach the markets at the moment. I think, and this was a perfect example of, really a great level to actually enter. I mean, when we see that that one right there, especially the one you just put on, that was a great buy zone. That last little low had the 20 moving average crossover as well. It was happy days. And they're the things that we're really looking for. Like I talked about it a couple of times this week in the streams, actually, that, in markets that are a little bit, well, not a little bit, very uncertain, these are the best ways to actually trade. It's short and sharp in terms of actually getting in and getting out, and using the dynamic indicators, especially to your advantage, to really give you that edge. Because that's what you need in a volatile market. The one thing you don't want to be doing is having a bit of a guess and just jumping on board a moving train. You really want some basis for that move. And yeah, I think the anchored VWAP, especially when it's adaptive like that, and moving it to the lows, the higher lows like Tom has just shown, is a very, very powerful technique.
So the question then becomes, can we use it on other pairs such as Bitcoin? Well, the answer is yes. Again, I would usually go with the first touch is the key here. And also understanding the structure of the higher timeframes is key. Remember, it is a momentum-based concept. That is that you believe a key level's been broken and that there is usually a fairly strong trend intact. And when you have a fairly strong trend, then you can kind of use this to follow that trend. So one of the things that we always want to look at is often the daily time frame first up, and the weeklies and those other things. So let's use Bitcoin as an example here, as it is probably one of the talks of the town right now. And that is that, of course, we've had this really strong bounce that we've been discussing in previous weekly shows. And then we've come down here to the daily, and we knew we were dealing with a pretty important supply level. Just give me 1 second, guys. And that basically that supply level obviously has led into a really, really good structural zone where the market clearly had some sellers. Somebody was selling because otherwise you wouldn't have seen these red candles start to appear. Then all of a sudden, we start to see this momentum shift, and the market still continues to make a series of higher highs and higher lows and higher highs and higher lows. So it remains in that bullish trend, doesn't it, Ty? But it's what we call dull. And whenever you have a dull, really just barely getting up there, you might think, well, that's a time for us to sell. There's a saying, and it says, do not short a dull market. And that's because until that shifts, we do not want to bet against this trend. It can be resetting indicators. And a great way of easily telling this, Ty, is to load up some of the indicators like an RSI or something. And we'll put an RSI just on here quickly. And the reason we want to do that is what you might notice is it isn't really weakening. It's just kind of sitting around. And then sometimes it will weaken and it will look like it's coming off that overbought. Stochastic as well is a very good one for this. So we could load it. I'll show you a stochastic. We'll put a stochastic on there. And often it will look like it's weakening. And you assume, oh, it's overbought. Oh, it's overbought. It's a great place to sell. But then it just kind of starts to weaken, triggers in those sells, and then bang, goes off. And this creates short squeezes as well. So do not fall into the trap of thinking that just because a indicator is overbought at a key supply, that's good enough. It can actually reset. And I've sometimes seen during these dull markets like this, RSIs and stochastics move down like this much. And then, of course, that resets to allow for those bigger moves. Ty, how often does that happen to you in trading and investing?
It happens a lot, and I think it's really, really important to identify and understand stochastic for what it is, and also an RSI for as another example, because those indicators can be very, very tricky sometimes. They can, you can think that they're about to reverse, and you know what, we know this firsthand because we did all this experimenting, probably what's pushing on 17 years ago now, where you would think that, that is exactly, it's funny now, isn't it, Tom? Like now that we look back on it, and now that we actually really have an intimate understanding of how the market works, how misled we were actually by thinking that of the indicators at the time, thinking, oh, this must turn around now because it's heavily overbought or oversold. But really, it is an accumulation. And Bitcoin, I mean, look, it bounced off a very, very good level. And I think you can see here, it's been fantastic. I mean, from a technical standpoint, it's really given a lot of good signals. I mean, even when it did break out of that, like you got two very, very good pullbacks to just a standard 20 moving average, let alone the dynamic one that you can add as a VWAP as well. So, and really the target obviously is around that 100,000 mark because we know that it's a very, very solid aim for, because it's got a pretty strong resistance there as well. So there's no, I don't think anybody's surprised that it's done this, is it? I think it's more about, the fact that if you got caught out trying to short it because you were misled by those indicators, that's when you get caught with your pants down a little bit. So I think it's very, very important to identify when the market is actually doing that and not get sucked in to what looks like a potentially weak market, but in actual fact is a potential breakup and a very heavy one at that. Because there's no stop loss that can contain that really. When it goes, it can really go.
Yeah, I mean, unless it went underneath 92,000, there was really no reason to say that this market was weakening. And the other thing as well is, even if we had come down to 92, and here's a bit of a pop quiz for everybody out there, what if we'd seen this on the candle? What do you think? Would you really have? What would you guys think out there in the chat? Would you actually think that is a sign to go bearish? If you'd waited, if you'd seen it go underneath 92 and it did this, what would you think? And obviously, it's a repeat of a question we asked before, but it's an important one because if you do see these types of things, again, repeatable processes. Can you do that 100 times? Can you do that 200 times? Can you do that thousands of times? Do you see it all the time? That would be a rejection candle. That could be a stop loss hunt. That could be, exactly as you guys are saying here. So absolutely correct there in the chat. So yeah, a really great example of how you can follow this type of momentum. And obviously now at the moment, the markets are ripping. So yeah, the anchored VWAP can be one of the techniques. Now, as Tyrone alluded to before, there are other techniques for following momentum. And one of those is, of course, the moving average that we talk about all the time, traditionally the 20 moving average. And the thing with the anchored VWAP that I like so much is that it doesn't really require a time frame. So that is that we could be on, we're just putting it behind a series of higher highs and higher lows in this case when we're following momentum. The thing with the 20 moving average is it's obviously based on the time frame that you're on, based on those periods, those candles. If you're on the 1 hour, then it will be based on 20 of those 1 hour periods. And of course, if you're using an EMA, it'll be more weighted towards the most recent candles. Now, the key to the moving average is one of our 1-2 systems. So what that basically means is that I like the 2 hour. I tend to find the 2 hour, the 4 hour, the daily, sometimes the 15-minute, the 1 hours can be good ones to look for. But what you'll sometimes find is that a market will track a certain moving average on the way up. So if we go back over to an example, maybe we'll just go to gold and see whether it's been tracking anything. Let's say we use this example here of when gold broke out in a big way recently. And you'll notice it comes down and it hits the 2 hour 20 moving average and then it makes a new high, okay? And then it comes down, it hits the 20 hour, 22 hour moving average, and it goes up again. Now, if that had been a more consistent trend that it's obviously rallied really, really hard. So I'm sure there's probably something on a smaller time frame here that might be doing it. But what I'd usually be looking for is a repeatable process. And that is that it hits a certain moving average and it does it once and then it does it twice. Now, I think on the 2 hour there, the third time it just kind of came down. That was a really aggressive trend, very difficult to get into, probably without an anchored VWAP. But 1, 2, and I always call it the 1-2 system, which is the repeatable process of seeing it happen once, seeing it happen twice, seeing it happen 3 times, seeing it happen 4 times, 5 times, and eventually it'll fail. There's the 5th time. So if you'd done this 1 time on the 1 hour here, 2 times on the 1 hour here, new higher high pulls back, take the trade, okay, good, comes back, take the trade, cool, comes back, take the trade, failure. Okay, so you would have 2 successes and 1 failure. And sometimes these can go for like 10 times. They can go for ages, can't they, Ty? I mean, I've seen some of these like little repeatable processes as markets break out happen heaps. The key to all of these, as markets break out, you're in consolidation and you break towards the trend, momentum is on. So you've always got to look at these when key levels are broken. I'll give you an example on US 500 just before we continue to go over there to Ty's thoughts here. And we'll just use this moving average and we'll go through. Okay, so that one's such an aggressive trend. So we would have to use a really small time frame. So we'll go smaller time frame, 10 minutes. Okay, so yeah, probably would say that is even not enough. So that's such an aggressive trend. We would need even more than, actually, no, that is it. That's enough. So, okay, so the market comes down and you can see here it goes, breaks through. This is Liberation Day, comes up to the 15-minute 20, okay, 1 touch. Wait for it to make a new low, makes a new low formed, okay. Second touch, okay, repeatable process, 1, 2. As it comes back up, 3, trade. 4, trade. 5, trade. 6, trade. 7, trade. New low, trade. Wouldn't call that a touch because it didn't. Trade. Trade. Lose. So that's actually a lot. A bit better than you'd expect. But that's a very aggressive trend and obviously a very aggressive breakout. So the key is momentum key levels. And you can do that by using some of the other things we talk about all the time on the channel and these videos, can't we, Ty?
Absolutely. And look, even though, I mean, we see a lot of entries there and you think, wow, that must be just like a one-off. There are sometimes trends that can give you 20 or 30 entries and they don't stop. And there's no reason, like Tom said, unless you're approaching an extraordinarily heavy level of support or resistance that you've got to be a little bit mindful of. you don't stop trading until it actually turns around, generally, as a rule. Like, you wait for it. If you get,
Yeah.
even half of those entries, yes, you may fail on the last one. And sometimes, you don't even fail on the last one because you can actually see the signs that it's turning around. But even if you do, you can't win every trade. Like, I think it's very important for people to understand that every single trade is not going to be a winning one. It can't be. It's impossible, right? So you need to get yourself into a system like we're talking about here, where you give yourself an opportunity to get a really good run on and get many entries. And yes, the last one will probably fail because at some point the trend has to turn around. But the important thing is knowing where your stop loss is going to be. And in these situations, your stop loss is always going to be just above the previous lower high. So you're never really going to be out of pocket a lot. It's only going to be a pretty small loss, right, compared to some of the wins that you're getting on the way down. So yeah, this sort of system, if you trade it like this all the time, it's a system within itself, and it's going to have a success rate that's going to put you ahead of the curve, no question, if you do it correctly. You just have to be really good with your stop losses and make sure that you're putting them in the right place, because that's vital. What you don't want to do is run with no stop losses, and then that one trade that does fail wipes out all of your gains. We don't want to be doing that, Tom. That's not something that we do. No. So yeah, you must have solid risk management and stop losses all the way down, and it's a very easy way to trade the market. And not just on the S&P 500. All liquid indices, currencies, and even some very liquid stocks have very similar pad-ups. They've got to be liquid. That's the key.
Yeah. And what liquid means, basically, guys, is large volumes, big amounts of trade activity. And you can really tell that if you ever look at the volume on the daily of any of these particular things. You actually look at the sheer size. Another thing to do is maybe just to ask, even possibly Pepperstone, or go to their website and say, what are your top most 20 popular, what are the most 20 popular, most big volume kind of positions? And then that'll give you an idea. But generally, you're going to be looking at gold, silver, Bitcoin, S&P, in NASDAQ, Euro, that kind of stuff, pound. I just want to show, again, the lows here. Again, the first touch in particular, very strong from the anchored VWAP setting. Now, we've got a question coming in here from Craig, and he says, I've got a lot of anchored VWAPs. Which one are you using? So I'm using the default one in the system, but I'll show you it here. Band multiplier is 1. Style is just set to yellow. It doesn't really matter. I don't have any of the band numbers on there. And you can see here, it's all pretty much the standard. And I've just got it set to H plus L plus C divided by 3. Now, I find this one is fine. That is just the basic. And sometimes the basic is best. I think that people get carried away by trying to fandangle everything. We've been there, done that, run the algorithms before they were called, when they used to be called expert advisors and robots. Now they're called AI algorithms, even though it's half the time.
I think it's very important. Yeah. I think a lot of people get caught in the trap of trying to chase an edge that nobody else is seeing in the market. When it comes to indicators, we've always found that the most popular are the best, and that's in settings. So you don't have to change around the settings to try and give yourself an edge. The edge is that actually the real edge, and I think a lot of people don't realize this at the start. The real edge is actually trading what everybody else is trading, Tom. It's a misconception that if everybody's trading the same thing, you're less likely to actually make money. When everybody's trading the same thing, there's more momentum in the market. So really, what you want to do is align yourself with the majority of where traders are going, and the best way to do that is to use indicators and settings on indicators that everybody, or for the most part, the majority are actually seeing. Otherwise, if you're the only one seeing it, what does it really mean?
I just want to reiterate one thing about the difference between the anchored VWAP and the moving average setting. The moving average setting, you are looking at a time frame with a 1 and a 2 system, okay? The anchored VWAP has to be based on structure. And what that means is you're going to use a higher time frame. You'll see I was just testing the 15-minute there for those little pullbacks, and it wasn't that good. And the reason why that is because it isn't based on a higher time frame structural change. And generally, you do want those higher time frame structural changes. So I would generally go with at least trying to go with half an hour, 1 hour, 15-minute minimum, okay, minimum, like we were showing 15 before. But you will find these ones that come off, let's say, a more like a 1 hour structure change, they tend to be a little bit better. And that's just the nature of course, you've got better levels of creation of volume and coming off those areas as well in terms of the continued momentum. So no worries, Craig. Thank you very much for the good question. So does anyone have any questions about those particular two indicators? Obviously, they're quite simple, and you might think, well, they're the most ridiculously simple things I've ever seen. Yeah, sometimes simple is pretty good. Remember, it's based on your knowledge, and the key here is of a key level being broken and therefore momentum coming into the markets. You have to think of markets, they move from equilibrium level to equilibrium level. So even if you think a level is going to hold, let's say you really believe that 5,500 or 5,400 was going to hold on the S&P, whichever one you thought was going to hold because of higher timeframes. When that market wipes those levels, that could be meaning a move to the next equilibrium level is paramount. And when that happens, the markets can move so aggressively nowadays that a lot of traditional methods aren't getting you in. So you need that repeatable step process so that you can firstly get into the market when other people can't, and you get reps in. And it's all about also having those stop loss levels, understanding that you actually have a system. What most people I find do when they first get into trading, Ty, and put your hand up if you've done this before, is that what you always tend to see is that people basically just go, oh, I short, and they sell, and then they go on and on and on and on about like how good, oh, I'm so good, I'm so good, I'm so good, because they get into this very aggressive trend and they think it's all great, and then they get kind of addicted to trading, and then they keep thinking that every move is going to be huge. The good thing about having a repeatable process such as the moving averages or anchored VWAP is you've always got a stop loss, you've always got some form of trail in terms of you can trail it through those moving averages as well, and you don't have some kind of just gambling nature in the markets where you're just thinking it's going to keep going and going and going. It's not about that. It's about a repeatable process. Stuart says, you often ask me to put my hands up when I have failed, when I have failed in the past years. So yes, I have done that. Okay, well, it does happen to the best of us, Stuart. Look, I'm not going to say I didn't do it either. Of course, we've all done it. And
we've all done it.
We learn from it.
It's part of the learning process.
Yeah. Does the indicator work on much longer time frames like the weekly? Yeah, but moving average is particularly good on the weekly. In fact, the weekly 20 moving average is an incredible moving average. I mean, you can see here, you'll notice it's what we call mean reversion. So there's the 1, there's the 2, there's your third one. Of course, you get one trade in, it goes to the highs, which is still a nice trade with the stop under here, probably about 2 to 1. Obviously, you can sometimes get into some epic ones there on the higher time frame stuff. The question is also, I guess, about anchored VWAP. Do you also get anchored VWAP? Yes. And that's a good key to the indicator. If an indicator works on many different time frames, it's super solid. If an indicator is specific, and you ever hear this, and I've never seen these work, Ty, when they say this indicator only works on the 12-minute time frame or the 38-minute time frame, or even the 1 hour time frame, it only works on the 1 hour time frame. Why is that? Is that because it's pigeoned to some particular market condition? It could be. So as you saw there, a lot of this is just literally me putting it in locations that I have a fair feeling it will work because I know they're momentum based. But I didn't know that. I just put it there. I didn't know anchored VWAP would come off that one because I just would guess it does because the 20's there and it makes sense to do it. And that's a lot of what we do is a repeatable process. So great question there. Thank you very much, David. All right, Ty. So, we've covered two really simple, what seems like simple topics. We've obviously talked about these ones before, but I think we've discussed it in a way that when you've got that momentum going in your favor, a very frustrating thing of the current market, that you can potentially start to build in that kind of little base structure concept of having a repeatable process. One of the things I want to leave the audience with and everyone out there today is that we've found that when you look at the psychology of generally people and how we make these mistakes, oh, I created an emoji on the screen. We tend to generally go with 40 reps. So that means that most people quit around 10 to 12 reps. Even if you only wanted to trial a system like this and bring your own stuff into it, if you just did it with $10 per risk per trade and you did it 20, 30 times and you kept the stats for that, at least then you've actually put the structure in place to get the reps through. Most people quit, it seems between 10 and 15 times. And again, I can put my hand up and say I've done that before as well. It seems to be 10 to 15 times. It's almost the stock one. The people that make it to 25, 30, and 40 reps, they're the ones that tend to have more success in trading, just in terms of whatever system they're looking at, because they get confident. And that means you don't have fear and you don't have greed.
Absolutely. And you have
any other
clarity
words
of
of
what
wisdom
you're
for
seeing.
everyone, Ty?
Yeah, I think that just building on that, when you've done that so many times, you understand intimately what you're looking for. And I think that makes actually trading easier, because then you know very, very quickly how to analyze many, many charts very, very quickly, which actually it's a double win, because not only are you analyzing more charts quickly, but it actually stops you from placing bad trades, because you'll realize that there's a lot more quality out there and you'll identify the quality a lot quicker. And that's why it's important. The repetition is very, very important, and to stick to it. If you believe it and you've seen it happen, just stick true to the process. That's the best advice we can give you.
Yeah, always stick to it. Always create a replicable process. And remember, with anchored VWAP, the first touch that's best. And that's what I was just highlighting here at the end. Guys, thank you so much for coming out and viewing today. We do appreciate you yesterday as well, bearing with us as we had those technical issues. If you're watching here on YouTube, remember, check out the links in the description down below and make sure to sign up so you can attend these for free weekly. We cover all sorts of different topics and we often look through the live markets. We didn't get into the currencies today too much. Obviously, the S&P is probably the more interesting one at the time of this recording, and Bitcoin and all of the cryptocurrencies. But as always, we usually cover those. We cover more gold, we cover silver, we cover it all. So if you have questions as well and you're watching this in video format, please get involved in the lives and come and ask us the questions yourselves. Thank you so much. And for all of us here at Pepperstone, we wish you the best of the rest of the week. Thank you, guys. Bye for now.
Thanks, everyone.